The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, joining us now here on Market Talk, every few weeks, we always like to sit down and have a wide-ranging conversation with David Widmar, economist at Agricultural Economic Insights. And David joins us here today on Market Talk for one of those great conversations. And David, it's good to talk with you again. Welcome back to the show. Hope you're doing well.
Thank you, Jesse. Always happy to join you.
Well, let's start. I just want to start in general here because I know the last few weeks we've seen the grain markets rally, then we kind of faded back, and then Monday we had this big move higher in the wheat trade that kind of supported everything. A lot of weather concerns around the world, quite frankly, especially on the wheat side, but even some planting hiccups, delays here in the U.S., things like that here. So I guess just broadly to start, your thoughts on some of this ebb and flow and some of the recent rallies we've seen across this grain trade as a whole, David. What are you keeping your eye on right now?
Well, one of the things I know we talked about some time over the wintertime, Jesse, was this idea of how tight or abundant are global grain stocks. And it's really a function of the world story that we're talking about. So in the U.S., we've seen a big rebound, but the rebound in stocks hasn't been as obvious at the global level, especially when you think about the grains that are available for trade. China has a huge store of these grains, but those aren't necessarily available for global trade. So when we start thinking about at the commodity level, wheat's been getting a lot of attention here. We think about, okay, what's the available stocks of global wheat that's available for trade? And that's what starts to create some of this head scratching and gets the markets really moving. But I think producers need to step back and think about where were their crop budgets, what's their cost of production, what were they putting into those budgets? And it was a pretty bleak time putting those budgets together just 2 or 3 months ago. Also, maybe it was difficult to make that January 1st balance sheet projection, and we put a corn price and a bean price where we had an inventory, and then those inventories got worth less and less as we move through. So now here's an opportunity to market grain at a higher price than we've seen, in the previous few months. So let's not sleep on that opportunity. Let's make sure that we're sharpening the pencils and making good marketing decisions based on our cost of production and not necessarily hoping for a rally to continue or to go even higher. It definitely could, but how do we make good decisions this early in the growing season, knowing our costs and keeping some options open for down the road potential in the market movement?
And you're always great at kind of framing up that discussion. That's why I'm glad you're on here today. I know, one day doesn't make a trend or a couple days doesn't make a trend, but obviously sharpening that pencil and taking advantage when it makes sense. I know a lot of times, and I'm sure you could talk about this, producers get fixated on X price over another, maybe $5 in new crop D's corn, for instance. They're waiting for that big round number, and then they'll be like, okay, well, I'll be happy selling at $5. But, in a lot of cases, if your cost of production it pencils out and you break even or make a little money at $4.95, $4.96, things like that, like being okay with not getting that exact round, shiny number, that's okay sometimes, isn't it, David?
Yeah, I think it's, to your point, Jesse, it's just important to step back and recognize that by default, we will anchor to these prices. Maybe it's a price that we wish we would have sold at last year. One of those pieces of Twitter advice that we saw going around last fall. I should have sold more corn at $5. Well, make sure you don't sleep on the next opportunity to sell corn at $5 or nearly $5. And, I think, Jesse, the other thing that we often anchor ourselves to, we anchor to the board trade price, but we also anchor to those local cash bids. And so we get fixated on, I don't want to let this go for 25 cents under, or I want a dime under. And we sort of get ourselves twisted in these logic loops. At the end of the day, we need to make sure that we look at the big picture. We know that we have cash flow obligations coming up right at or after harvest. Sit down and think about what's those obligations that I need to meet. How many bushels do I need to get marketed by harvest? And what kind of price do I need to really meet those goals and meet those budgets that I have put together? And if now's the time to, lock in some of those prices, do what's comfortable given where we are in the growing season. Admittedly, it's still pretty early. But again, the last thing I'll mention here is that there's a lot of talk about the markets being willing to price in a premium for the crop when there's a lot of weather uncertainty, and we're starting to enter that weather uncertainty window, this idea of June and early parts of July. So we're starting to move in that direction. So make sure you've thought about your cost of production, your strategies, and how you might take advantage of that when the time comes.
Real quick on the global balance sheet side, I know you do a lot of work there. Out of the three main commodities, corn, beans, wheat, uh, is one or the other a little more top of mind for you? I guess maybe either in a good way or a bad way that we just have too much. I mean, what's the one that stands out to you most that you want to watch here as we get into the summer months, David?
Interestingly, I think that wheat is the one that's really kind of been driving a lot of this over the last few weeks. I think wheat's one to keep an eye on moving forward. Keep in mind there's a couple things going on. Some cases, wheat is a substitute for corn, especially getting into the feed situation. But wheat also has a bit of a canary in the coal mine situation to it, where it's a food crop. And so when there starts to be a lot of concerns about specifically food for human consumption, wheat can sometimes really get on a tear. We saw that with the Ukraine invasion, and we've seen that through other points of history. The thing I'm specifically keeping an eye on here is, how much export activity can Russia accommodate or allow or stand in as we move forward? As we think about these other crops, think about corn and soybeans around the world and here in the United States, we're in a situation where we're at this point where stocks are abundant here in the United States, but the global situation is a little bit more tight when we look at it globally. And so if we were to see some sort of global concern, the thing that producers should keep an eye on is export activity. So if we start seeing an uptick in export activity here for the summer, but also into that new growing season, that's going to be really starting to shift the tone of the marketing season moving forward.
Let's talk inflation. As you think about exports, the value of the dollar as we look at our export markets, the Dow Jones breaking 40,000 for the first time here last week. I know that was a big highlight event. I mean, just this overall inflation story, shrinkflation, reinflation, all the different terms that are out there, David. Your view of the broader economy, the ag economy, et cetera, here as we're kind of moving forward and continuing to fight this sticky inflation environment?
I think one of the key points to keep in mind here that I want to share with listeners and viewers is that this is a long battle. This is not a war that gets made on a made or broken on a monthly basis. We have at least three measures of inflation, and we can sub-measure those to infinity if we wanted to, but there are lots of data drops about inflation. We sometimes get hyper focused on this latest data. I think the summary that I look at is that, one, we've made a lot of progress on the battle of inflation, but two, we haven't met the Fed's long-term goal of getting us back to this stable state around 2%. It's going to be a bumpy ride as we've seen in the last few months. So what's that mean? Well, we're going to have to keep an eye on the Fed's efforts to slow down the economy. Are they going to be able to lower these interest rates as they've talked about? That seems to be maybe a little less likely here at the end of May as we're recording this. I got to timestamp this because these things have a way of changing really quickly. But we also see the Fed's going to slow down its balance sheet tapering activity. So that's going to help the economy in a little bit of a fashion. But I think the big takeaway is that there's a lot of uncertainty, and unfortunately, agriculture is just kind of along for the ride. What happens in grain prices or farmer profitability or global trade of ag commodities or U.S. trade of ag commodities is sort of a small passenger on a really big train that's barreling forward, and that's the U.S. economy and the global economies. The other things I'll mention, Jesse, is that as the Fed gets a handle on inflation, that tends to make our dollar stronger, and I'd like the term more expensive. And so that makes it harder for us to compete in the global markets. And the other thing I'll add is that inflation thus far has been a global phenomenon. It's been a global challenge. And so we'll have to see how this resolves itself, both domestically, but also abroad.
higher for longer has been the term that's kind of been thrown out there. And that the Fed, originally we're thinking multiple rate cuts this year. And now there's kind of that talk that there might not be any or one or two later in the year. Is that kind of the feeling you're getting from the Fed right now, David?
Keep in mind that they could make multiple rate cuts. A rate cut is kind of anecdotally referred to as 25 basis points. So they could make, so the idea of 3 basis cuts were like 75 basis points worth of reduction. They could make all of that in one meeting, or they could split it up into 2 or 3. So they could do that a little bit more aggressively. They have a long time here. I think one of the things that they're trying to avoid is the calendar. They have a tough calendar ahead of them with this November election coming up. I'm sure there's some questioning and backseat driving and second questioning about how they should time those, what's the appropriate way of handling that ahead of the election. But then they also have a Fed meeting after the election, so they have some a lot of tools and levers. But we did see that they said they're going to reduce the rate at which they're shrinking the balance sheet. That is, akin to dropping the rates a little bit. It's going to start in June. It's not as obvious as obvious as those rate cuts, but it is another way the Fed sort of taking a look at the economy and saying, how do we make sure the economy still grows and that we don't create a stall? Because at this point, we're worried about stalling the economy, and we also want to get inflation under control. The last thing I'll add is that the Fed's job has been relatively easy to this point. What makes a Fed policymaker's job is really difficult is when we have stubbornly high inflation and high unemployment rates and an economy that's just not growing. So this is something that we've been able to thankfully avoid. We've had a robust economy. We've had a resilient labor market. It's just this inflation that's been a little stubborn.
We're talking today with David Widmar, economist with Agricultural Economic Insights. Learn more about them online at aei.ag. David, I want to talk about a couple different things that you guys are working on there at AEI. And you mentioned this to me, the evolution of CRP and the Conservation Reserve Program is what I'm talking about, and acreage there and more. Talk to me about some of the work you guys are doing there and some of the findings that you are getting out of that research.
Yeah, this is something we're going to wrote our first piece, and we have a couple more pieces coming out about this. But, the CRP program, the Conservation Reserve Program, was sort of a residual program out of that 1980s foreign financial crisis. The federal government had been using the payment in kind or PIC program to idle farmland during that farm crisis. And the CRP program was sort of a long run effort to first bring cropland out of the supply side of the equation, but also put into a long-term conservation program. And the third piece was how do we do this in a way that's, it makes sense from an environmental and from an economic standpoint. We want to put the most sensitive lands into these reserve programs. And so the reason why we talk about this is Conservation Reserve has ebbed and flowed. It's kind of had a 30 million acre average, so to speak, or a normal. It got as high as 37 million acres towards around 2007 or 2008. And then it's been on this shrinking decline ever since. But what we've noticed is there's been a bit of an upturn in the last few years. And historically, we've thought about that as, CRP acres going into production, it's less cropland, or CRP acreage reducing, it means more U.S. cropland acres. But what's really important to note the last few years is this upturn has been for a new program targeted at grassland. So it's working pasture, it's working hayland, that it's a different program. It's a bit of an evolution in this program. And so we shouldn't be thinking about it necessarily as strictly a substitute for grow crop production. It's starting to look very, very differently. And again, we're going to keep diving into this, but it's, if you really looked at this a little bit, one of the challenges that they haven't got any new program dollars. And we all know what cash rents have done over the last 10, 15 years. So you have a fixed amount of dollars and you have higher cash rental rates. Well, they can't afford as many acres. Well, now they've moved into this grassland programs. And so that has allowed them to spread those dollars over more acres and to get the total program enrollment up. But again, swapping out cropland for pasture or hayland acres.
Interesting stuff. We'll be watching as you guys dive deeper into that topic, no doubt. One other topic I know as well you guys have been looking at, and there's been a lot of talk, of course, around the expansion in soybean crush and soybean oil production here in the U.S. specifically. And you guys have some research you're doing on that front as well. Talk about that a little bit.
Yeah, here in 2024, for the 24-25 marketing year, the USDA had its initial estimate of soybean oil production and usage, and this is the year where biofuels is going to be slightly behind the food, feed, and other industrial uses. So we talked about this as the diesel versus donut debate, going back to that food versus fuel debate. So this diesel versus donut oil, all the oils that we're using for human consumption, will this be the year, or is it next year that biofuel overtakes and is the largest user of U.S. soybean oil here in the United States? The second thing I really want to point out is this upturn in biofuel usage has really been taking root for the last decade. We've been focused on it for the last couple of years, but it's a 10-year trend. Soybean oil going to biofuels has displaced a lot of export activity, and we haven't seen much growth in that food, feed, and other industrial uses categories. The last piece here that I really think is important to look at is the trend line for U.S. soybean oil production is surprisingly linear over the last 10 to 15 years. If you're really statistically nerdy like I am, the trend line is 0.98, which means about 98% of the variability in annual soybean oil production going back to 2011 has been from time. So time can account for that. So less than 2% of the variability in that data is from other things. And so what I'm watching and looking at moving down the road is all these plants that are going online. Are they going to fit into this trend line, or are they going to sort of put a kink in this trend line and we're going to start growing at a new threshold? This is sort of a new, some of these new plants are going to start to come online, and we're going to start to keep an eye on this. But overall, that's sort of the big picture trends. And of course, the crush margins for crush plants hasn't been nearly as attractive the last couple of weeks or months as they were back in 2022 when the heyday of all this was really underway.
A lot of great stuff. I know folks can find all that information on your guys' website, aei.ag. And with that, David Widmar with Agricultural Economic Insights. We appreciate you joining us here again on the show, and we'll look forward to catching up with you again down the road. Thanks so much for the time.
Thanks, Jesse.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.